Hi, and welcome to this Trader's Textbook Lunchtime Bite. Today we are going to be discussing momentum. But, more specifically, how we can track and measure momentum with the RSI indicator. When analyzing a chart, we always say, price first. As a trader, you should always focus on what the price is telling you first, before you look at any indicators. You then use your group of indicators to back up your view of what the price is telling you. So to quickly recap, a simple and effective trading setup consists of indicators that measure 4 key areas. You start by looking at the price and what it is telling you. Then, you want to have something that measures and helps to determine the trend. You then want an indicator that measures momentum, something that measures how volatile prices are. And then finally, we want to look at volume. Volume shows us how much participation or enthusiasm there is. Today we are going to focus on momentum. These types indicators are also often referred to as oscillators. But, what is momentum exactly? What does it mean? Well, momentum is the rate of acceleration of a security's price. So a momentum indicator essentially measures the rate, or the speed, at which prices rise or fall. By understanding this, we can get a good understanding of price strength. A popular indicator for something like this is the Relative Strength Index, or RSI for short. Another great example of a momentum indicator is a stochastic. The RSI is an indicator whose value moves back and forth between 0 and 100. So it is pretty easy to read and provides valuable insight into the strength and weaknesses of prices. If we bring up a chart and add an RSI, we can see it here fluctuating between 0 and 100. As an indicator, the RSI can be used in a few different ways. We're shortly going to look at 2 ways in particular. But for now, let's understand how we read the RSI. The RSI essentially measures the number of up or positive closes relative to the number of down or negative closes over a period of time. This is then expressed as a percentage, which is why the value ends up being between 0 and 100. Typically the time period used for the RSI is 14. The RSI's value moves higher when the average gains over a period of time are larger than the average decreases over that same period. To put it another way, if for instance, the RSI's value is 100, the highest possible value, this would mean that over the last 14 periods or days, it was all gains. There were no down days. So all the candles were green, positive and up. Now, the RSI moves lower when the average down days over a period of time are larger than the average gains or up days over that same period. Again, if the RSI value was 0, and we were looking at 14 periods, this would mean that over the last 14 periods, it was all down moves. All the candles were down and all the candles were red. Now, the RSI tends to have 2 horizontal lines, with the first line drawn at a level of 70, and then the second line at a level of 30. Therefore, the very basic way to read the RSI indicator is that if the value of the RSI is in the upper percentile, so above 70, like we have over here, this would suggest that the security or market is overbought. Overbought implies that the market rally might be a bit overdone, and that the price could pause, or even correct. Why, you ask? Well, because it shows us a strong run higher in the price, which is possibly not sustainable and may be due for a correction. An RSI that is above 70 is essentially saying that over the past 14 periods, prices have gone up more than 70% of the time. If on the other hand, the RSI is in the lower percentile, so below the 30 line, this suggests that the security or market is oversold, like we have circled over here. Oversold implies that the market sell-off may be overdone, and could pause or even rebound. This is because it shows a strong run lower in prices, which may not be sustainable, and the price therefore may be due for a pause, or even a rally. The RSI is calculated using the following formula, which requires a few steps. But, for our purposes today, we are not going to delve too much into this. It's more important that you just understand how the RSI works and what the values are telling us. Now, the RSI indicator is typically used on daily charts, with a period of 14. So if we are looking at a daily chart, it means that we are basing the RSI on the past 14 days. Despite it typically being used on daily charts, it can obviously be used on any other time frame. For instance, a 14-period RSI applied to an hourly chart means that the calculation will be based on the past 14 hours. It is important to note that if you decrease the number of periods, you make the indicator more sensitive to the latest price changes. And then on the other hand, if you increase the number of periods, you end up making the RSI less sensitive, as we can see here. Okay, great. Now that we understand what an RSI is, how do we use it for trading? There are two main approaches. Namely, overbought and oversold. And then, using it for divergence. So let's look at overbought and oversold first. Looking at the RSI, we already know that when an RSI is above the 70 line, it is considered to be in overbought territory. And when the RSI is below the 30 line, it is considered to be in oversold territory. Great! But unfortunately it is not as easy as simply buying when the indicator is oversold, or selling when it's overbought. Because, quite often, the market can continue in these territories for quite some time. So some confirmation in terms of the change of direction is therefore needed. A popular approach is to first allow the price to cross below the 30 line and then rally back above the line before buying. Like we have over here. Likewise, you can let the price cross above the 70 line and then cross back below it before selling, like we have here. This approach can work quite well in ranging markets, when the price is swinging back and forth between overbought and oversold. In a previous webinar, we learned how to determine the trend using moving averages. So if we now combine the RSI with a moving average, we can approach a trade as follows. Consider this chart, where the price is trading above the 200-day moving average. And because the price is above the moving average, the trend is considered to be up. And because the trend is up, we therefore want to trade with this uptrend. And once the trend is identified, we can then take a look at our RSI to try capture swings in the overall trend. In an uptrend, a move out of oversold territory, as indicated by the RSI and highlighted on the chart, can be considered a signal to buy. So for us to take a long position. For instance, if we had taken on this trade, we would have likely looked to place our stop below the last previous trough like we have here. Then to get out of the trade, an overbought signal, maybe a signal to exit the trade. As highlighted here. That would be our exit signal, coming out of overbought territory. Remember, if the trend is up, we are generally only looking for long trades. Until the trend changes, of course. Let's now look at a downtrend. In a downtrend, the moving average is above the price. Therefore, in a situation like this, a move out of overbought territory could be considered to be a sell signal. We would then look to place our stop above the last peak, as we have marked here on the chart. Then with the RSI, a move out of oversold territory, so cutting above the 30 line, can be considered a signal to exit this short trade. So this is a very simple approach to using overbought and oversold, as a way to monitor and trade with the momentum of the price. Let's now look at the RSI's second use. Divergence. Divergence is very powerful. And you get two kinds of divergence which are both similar. You get bullish divergence. And then you get bearish divergence. So let's take a closer look. Bearish divergence is when the price is rising, but the RSI is actually falling. This serves as a warning signal. It warns us that the price could soon correct lower, since buying momentum is slowing. So the rate of acceleration is slowing. In other words, prices are increasing but at a slower rate. Keep an eye out for this, in that it often means the market is feeling a little overstretched and might be about to pull back. Bullish divergence is the opposite. That is when the price on the chart is falling, so the price is making lower lows. But the RSI is in fact rising. Again, this is a warning signal. It warns us that the price could soon correct higher. Because buying momentum is starting to develop and grow. So the rate of acceleration is increasing. So the important thing to remember here is that divergence warns us of a possible change in the direction of prices. Because the momentum or the speed at which prices are moving is changing. Divergence, be it bullish or bearish, is not a timing signal. Because the market can remain in this state for quite some time. But rather, divergence helps to confirm other signals. And lets a trader know when a trend may almost be about to change. It's really just a big warning signal. Thank you for joining us today for this Trader's Textbook Lunchtime Bite. Be sure to reach out to us with any questions you might have. Have a wonderful day.